Hello, Business 500D students. This is Professor Hassey. Today's date is Tuesday, July 5th, 2022, and I'm wrapping up last week's week number 4, the week ended July 3rd in this video. Capital valuations, bonds, and stocks. And again, I apologize for the lateness of this week. I've had some family in the hospital and had to take care of some things and got a little bit behind, and I apologize, but I've extended the assignment number 2. It's not due until Sunday, July 10th, and I'm going to introduce that assignment in today's video. So again, I apologize, but hopefully all is back to normal now, and I'll give you your week number 5 video tomorrow on Wednesday. Okay, so we're going to talk about bonds specifically today and bond valuations, because in order to determine financial strategy, you have to understand the basics of where your capital comes from and how do you provide and understand their value and their return in the marketplace. Well, as we've discussed in earlier weeks in this class, the risk and return, the time value of money, all these play into the valuations of bonds and stocks in the market. And that's part of our discussion today and in assignment number 2. So let's take a look at a couple of things in our Blackboard, and then we'll talk about bonds specifically in this video. So here is our Blackboard, which hopefully you're becoming familiar now that we're at the halfway point of our class. And speaking of that, if any of you have any concerns or questions about the course or where you stand or anything, please feel free to get in contact with me, send me an email, post to the questions and comments section of the discussion forum, any questions or concerns you have, anything I can clarify or make sure you understand what we're doing in this class. All right, so first of all, as you can see, here is our plan in our class thus far. And as you can see, we have an assignment due this coming Sunday, June 10th. Then we have another assignment each week for the next few weeks and the remaining weeks of our course. So work to do every week from the balance of our course, just so you're aware of that. Here is our week number 4. And in week number 4, there's 2 spreadsheets. One, we'll be looking at both these spreadsheets in this video. Part of the assignment in number 2 is to update your stock portfolio of your investments as of Friday, July 8th, and we'll talk about that. And then this week 4 in-class work spreadsheet defines stocks and bonds for us. Again, once we have this under our belt, then we'll go into more financial management strategy and work about how we use this information, time value of money, risk and return, capital asset pricing model, bonds, stocks, and use that to make strategic decisions in investment of capital. And that's the second half of our course. All right, so let's take a look at stocks and bonds. Remember, the key to a company is to provide a service or to provide a product that is marketable, that consumers and customers are willing to purchase, and then getting that product or service to the market. Well, to do that, you have to have assets, equipment, buildings, land, distribution networks, people, all kinds of assets to get that product to market. And the assets have to be purchased at a price and funded by 3 ways. Remember, the 3 ways of financing legally assets in a corporation are the borrowing of money, and there's 2 ways of borrowing money. Short term with no interest, mainly accounts payable, which is due in 30 days, or long term, which is the main form of borrowing for corporations, long-term debt in the form of bank loans, or if it's larger money, bond financing. And those are financing that you have to pay back the maturity and interest based on your company's credit over a period of time. That's the first way of financing assets. The second way is stocks, selling equity, issuing stock, issuing ownership to other parties in your business. Now, it can be private ownership like Shark Tank or private equity funds, or it could be public ownership where you sell stock to the public markets. And it's that public markets is traded on the various stock exchanges around the world. It's equity, another form of raising capital to purchase assets. And the third way of purchasing assets and getting capital is naturally the old-fashioned way, making a profit, making money, where that money is reinvested back into the company. Now, there's a problem with making money because usually the management of the company is in a perilous situation. When you're making money, the owners, the investors, the stockholders are going to want to get some of that money as a return on their investment. So you have to make a decision of when and how to pay dividends to those investors, and also take advantage of what the market perceives the stock price is worth in the market. So how much you keep and reinvest back in the company of your profits is a major strategic decision of financial managers. Well, this week and next week, we're talking about bonds and stocks. Bonds especially is the major form of funding for corporations. Why? You have access to huge amounts of money. You don't have that access to huge amounts of money with banks. Yes, banks will lend you money, but they can only lend you enough to their reserve capabilities and to make sure that the risk is not there to their ownership of their bank. So they're limited about how much money they can give you. So that's where the bond markets are attractive. Bond markets are the whole overall capital investment market in the world. Investors, foreign countries, private investors, pension funds, insurance companies, investment houses, all issue or get corporate debt or bonds. Why is it attractive? You know when the money is going to be paid you. With bonds, you have coupons. Those coupons are usually paid every 6 months or once a year. You know when that interest is going to be paid. Also with bonds, you know the maturity date. You know when the money, the principal, is going to be paid you. That's attractive. Now, granted, the returns and the interest rate is not as high as stocks, but that's really a lot less risk. If you invest in stocks, you're not guaranteed anything unless it's a preferred stock where the dividend is guaranteed, but you're not guaranteed return on investment. It's based on the performance and the market appreciation of your company. Nothing's guaranteed in equity ownership. And also, should the company fail and go bankrupt, you lose all that equity. Bye-bye. In a bond, you know when you're getting your interest payments, you know when the money is going to be paid you at maturity, and should the company go in default or bankruptcy, bondholders are at the top of the list who get paid once you start selling off the business assets and acquire liquidity, and that liquidity goes to pay back those investors. That's why bonds and debt is so attractive in the market. Now, in these days of high inflation, not with the inflation rate now 7-8%, these assets or bond investments aren't as popular because you can make those money elsewhere with the inflationary times. But many people choose bond investments for their security, their risk-freeness. And that's why understanding debt and fundraising is so important. Let's take a look at a typical bond. Let's say a company is going out and going to borrow some money, and we'll keep this fairly in small amounts of money, but the average bond in the market is $1,000. You can only buy bonds in $1,000 increments. That's corporate bonds. You can get government bonds in smaller amounts, but corporate bonds are sold in $1,000 increments. Let's say a company has a credit rating of BBB+. All right. So based on that credit rating in the market, if they go out and borrow that $1,000, ask people, would you lend us $1,000 and we'll give you a bond? The market will set that interest rate based on that credit rating. In this case, the market sets the rate at 7%. So that means a coupon of 7% on this $1,000 bond will be paid every year. 7% of $1,000 is $70. To get that 7% rating, the company says we'll pay the investor that $1,000 back in 10 years. So now the investor who buys that bond and lends the $1,000 to the company is guaranteed to get a check for $70 every year for 10 years and then get their $1,000 back at the end of those 10 years. Now, yes, you can make more money elsewhere, but those require risk. Here, you buy this investment, you know you're getting $70 every year, and you know you're getting your $1,000 back in 10 years. That's why bonds are attractive to investors. And that's at the same time why bonds are attractive to capital fundraisers in corporations. They can lock in their budgets. They can lock in their required return on their investments to these interest coupon rates and principal due dates. Now, let's say you want to be this. I want to give you an example of, okay, you go out and lend $1,000 to a company and they give you a bond and they pay you $70 every year for 10 years. But let's say you want to sell that bond as an investor after a certain amount of time. And the reason why I'm going over this is because it shows how if the markets change, asset values or bond values or any other type of assets lose value. In inflationary times, when money is expensive, asset values decrease. In low inflationary times, when money is cheap, like it's been just up until the last 6 months, assets values increase. So let's say after 2 years, the investor of this bond decides to sell it in the open market. They don't want to wait the full 10 years to get the $1,000. They want to sell it. So they go to the bond market after 2 years and they decide to sell the bond to the market. And the market goes, okay, we'll buy this. In the market, they find an investor. But the current yield on this bond in the market now is not 7%, but 8%. The interest rate in the market has gone up, probably for a variety of reasons. Reason number one, maybe the credit rating of this company has gotten worse. Why has it gotten worse? Maybe the economy has gotten worse. Another reason is inflation. Money is more expensive. So the current yield on this bond now is 8%. Because of that, this $1,000 bond is not going to be worth $1,000 in the market because the yield is higher than the coupon. How to calculate that formally? Formula, function, financial, PV, present value. What's the present value of a 7% bond in an 8% market after 2 years? The rate is 8%. There's 8 years remaining. 2 years have gone by, so 8 years remaining. The payment on this bond is a 7% coupon of $1,000, so that's $70. And the future value is $1,000. At the end of the 10 years, you'll get $1,000. So in other words, we're trying to determine the present value today, looking ahead 8 years of payments of $70 a year with a maturity of $1,000 in an 8% market over these 10 years. What's the present value? $942.53. That's an excellent example of showing you that the interest rates have gone up, the bond value has decreased. And that's what's happening exactly today in the markets. Bond values are dropping because of the current yield is rising. And the indicator of that is the basic yield rate of the 10-year United States Treasury. It is going up. When that goes up, all other money for debt increases. To look at another example of that, let's look back maybe 3 or 4 years ago when interest rates were dropping. Let's say if I decide to sell this 7% coupon after 2 years in a 6% current yield market, what would I get for that bond? Now, in this case, this was 8%, the price went down 6%. What will happen to this bond value today? Same formula, function, financial. What is the present value of a 7% bond in a 6% market? The rate, 6%. Same 8 periods remain. The payment is still $70 on this bond every year, and its future value is still $1,000. Remember, I put a negative into these numbers, -70, -1,000, to make it a positive number. That bond is worth $1,062.10. In other words, the present value of this bond value has increased because the money is cheaper compared to the original issuance of coupon of 7%. This is an example of a bond being sold at a discount. This is an example of a bond being sold at a premium. But we use the concept of present value or time value of money, the present value calculation, PV, to determine that value. Being able to calculate this is not that big of a deal, but hopefully you can do that. The most important thing is understanding the concept behind this. If interest rates go up, old assets go down in value. If interest rates in the market go down, existing asset values go up in the market. And that's an important thing to know for a financial manager, because as money gets cheaper, then it becomes more prudent to borrow money. A lot of companies are not borrowing too much money these days, waiting to see what's going to happen to interest rates. Now, some companies have to borrow money. Retail companies have to borrow money now, especially now. Maybe now it's even too late, because they have to provide orders for their Christmas products. And those Christmas products probably have already been ordered and are being delivered now, July, August. So they've already had to pay for those in advance. Sometimes whatever the interest rates are doing, you still have to buy that retail goods to have it for Christmas time. Money becomes more expensive. Those costs have to be passed on to the customer. And that's the inflationary cycle we're going through now, just beginning. And when people see higher prices, that means they might not buy as much. And what could happen is a recession, a complete slowdown. Remember, the definition of a recession is 2 consecutive quarters of a decrease in GDP, gross domestic product. We've already had one. We're waiting for the results of this quarter, June 30th. If we have a negative GDP, we are in a recession. And the latest activity in the stock markets, dropping immensely over the last month or so, is the stock markets are telling the world, yes, we think a recession is coming. And that's what a lot of economic people are thinking now, and the same with corporate people. If we're getting ready to hit into a recessionary times when sales slow and costs increase, companies, managers, financial managers have to be prepared for that. And that's what a lot of companies are doing today. So that's a great example, using debt, bonds, and understanding interest rates and the ability of valuation of bonds and the ability to know in advance as much as possible as a financial manager what's going to happen to your costs in inflationary and also recessionary times. Remember, recessions are evil. People get laid off, lose their jobs, money becomes scarce, People don't buy homes. They don't buy cars. They don't go on vacations. We just went through that a little bit with the pandemic. Now we have a full-blown recession because how we got through the pandemic is money was cheap. Interest rates were low. There was no inflation, thus no recession. We got by through the pandemic by cutting costs, managing our expenses, and getting through it. But now in inflationary times, the risk of inflation and direct slowdown in the economy is quite high. And that's what you have to understand as a financial manager when these cycles come through your industry, because it affects technology industries different than retail industries, manufacturing industries, sports management. All different industries are effective differently. And as a proper manager, you need to understand that in your particular industry and market. This is a good example of bond financing. Let's look at this example again. Let's say we have a $1,000 bond today with a coupon of 8% or $80 a year that again matures in 10 years. After 1 year, we decide to sell that bond with a yield in the current yield or a yield to maturity of 10%. Based on our discussion up here, that means this bond is going to be sold at a discount. The yield in the market is greater than the coupon. Let's make sure of that. Formula, function, financial, present value. The market yield now is 10%. The number of periods are 9 in this case left to maturity. The payment is $80 a year. It's an 8% coupon. And the future value is we get the $1,000 back in 9 years. What's its value? Ouch, $884.82. Why the bigger spread? Because in this bond up here, 2 years have already gone by. In this bond, only 1 year has gone by, thus more decrease in value. And again, let's take a look at what happens if the current yield in the market of the maturity is 6% in an 8% bond. Formula, function, financial. Just practicing this because it's good to see it. 6% bond, 9 years remaining, $80 coupon payments, and $1,000 maturity. $1,136.03. Again, quite a nice little premium. So if I owned a bond and interest rates were dropping, I might want to sell out, make a nice little profit, and quickly. I don't have to wait the full 10 years to get my money. I can sell my bond now after 1 year and make pretty good money. So that's how the bond market works, and that's how the debt market works. Debt is driven by yields, credit ratings, risk, maturity dates in the market. All is simple. If you just hang on to the bond over time, you'll get your money, you'll get your maturity. But if the bond values change because of the relationships to the yields in the market, that's why so many people watch the 10-year United States Treasury yield. That's the base mark. If that goes up, all other interest will go up. If that goes down, all other interest will go down. And in the last few weeks, more like few weeks, last 4 or 5 months, the Treasury yield is constantly getting higher and higher, and that feeds inflation. And that's where we are today. So that's a great representation, or kind of a good representation of the bond market, something you need to know about, because further on in our strategic discussions in future weeks, this is an important concept to understand. In week 5 this week, we talk about stocks. how their valuations affect us. And we're going to begin that discussion of stocks by updating our portfolio with assignment number 2. And this sample portfolio is located in week 4 in the in-class review spreadsheets. I want you to update your portfolio as of this Friday, July 8th, at the close of the market. So I want you to add another layer to your portfolio. Here's my original portfolio of June 10th when we started the class. Invested 100,000. These are the shares I purchased by dividing the price into the investment to get the shares. Here's the latest, or the original, Dow, S&P, and NASDAQ market valuations. Then I want you to update it for this Friday, July 8th. Now, naturally, these are unknown yet, but all I want you to do is copy this down into this one and bring your portfolio down and now determine what the stock price is going to be of this Friday, July 8th. But here's the difference. When you bring this or copy this down, you're going to need to just copy the values of your shares, not your original equation, because you've already purchased the shares. So when you begin to open up this new lines of your portfolio for July 8th, you copy the shares down to the new value or to the new part of your spreadsheet and paste them as values. Watch what I'm doing here. I'm pasting them as values to keep the same exact amount of shares that I originally purchased. Then when I find the new prices on July 8th, I'm going to now multiply the new price of stock on July 8th, time the original shares I purchased, and I will get my new value. Now, I highly doubt that I'm going to make $9,000 or 9% over these last few weeks. Matter of fact, it all has gone down. But you get the idea. You'll copy the original shares as values here. Then you multiply the price you find on Friday, July 8th, times that. If you notice here in the cell, it's taking the price times the shares to get the new valuation. And that'll give you an idea of where you have gone down or gotten better from your original portfolio value of 100,000 on June 10th. And notice I do a calculation. I take the difference between July 8th and June 10th and divide it by June 10th to get a percentage change. I want you to do that. I want you to do the same for the Dow, the S&P, and the NASDAQ. Get their new values on Friday, July 8th, and then find the difference between July 8th and June 10th, and what is that in a percent? How is your gain or loss in your portfolio over the last month compared to the market indexes over the last month? That should be interesting to see how that's changed. Notice I filled in the beta and dividend columns, but you don't have to do that. Matter of fact, I'm going to wipe that out now. You're going to do that in later work in this class, so do not worry about that now. So that's what I want you to do in assignment 2, is create a new portfolio or take your existing portfolio spreadsheet and update it and include it with your assignment 2 work due July 10th. And this is available for you to review and even use in week 4 of our class file folder. So let's take a look at what assignment 2 is all about. Assignment 2 is, again, updating us as MBA students into the skills of financial management and corporate finance. A question about bonds, like we just discussed. That's chapter 5, by the way, and I will change that. We'll talk about chapter 4, time value of money, and the definition of amortized or unamortized loans. We'll update our stock portfolio as of July 8th. And we'll make a definition of the capital asset pricing model. What is it? What does it tell us? give an example of the capital asset pricing model. This is from our risk and return work of Chapter 6. Remember, the capital asset pricing model is used to determine the return on a specific stock in relationship to the other market indicators at the present time, risk-free rate and market return rate. So take a look at that. Give me an example. You can even use one of your stocks in your portfolio. So that's what assignment 2 is all about. Understanding how we manage debt and equity as financial management. You have until Sunday, July 10th. If you have any questions or concerns about that, please let me know. One last thing to note about debt is debt has one of the key functions of why companies issue debt instead of equity. You get a tax break. Interest expense on debt is tax deductible for corporations. Example, using the example that we talked about earlier about this 7% $1,000 10-year bond. The coupon payment is $70. In other words, $70 interest expense will be paid every year to the holder of this bond. Well, yes, the company has to write a check for $70, but on their tax return, that interest expense is tax deductible. It's a business deduction, decreasing their tax liability on their profits. It's an expense of the business. How much of an expense? Well, it's based on the corporate tax rate. Let's say this company had a corporate tax rate equaling 20%, which is about the norm these days. It's actually maybe 22% in the real world, but let's say it's 20. So what is the after-tax cost of debt for this company? The after-tax debt cost is equal to the interest rate on the debt times 1 minus the tax rate of the company. In other words, the interest rate is 7%. We're going to take that 7% and multiply it times 1 minus 20% to determine what the after-tax cost of debt is for this company. So if I put that into an equation, equals 0.07 times 1 minus 0.2, 20%. And I get 7% times 80%, or 5.6%. So yes, their coupon payment is $70 and 7%, and they have to pay that. But with the tax deduction, it's only actually costing them 5.6% because they can deduct 20% on their taxes, on their tax return. You can't do that with dividends. You can't do that with stock gain. That's, again, another reason why debt is an attractive funding source and the larger source of a capital structure of a company, is because you get a deduction by issuing that debt on the interest. Another important concept. Debt is tax deductible. Equity is not. Another thing to remember down the line. Okay, well, I'm going to post this spreadsheet to week number 4 along with this video. And then next week, we'll talk about stocks, or excuse me, this week with our week 5 video, we'll talk about stocks. We'll look at our portfolio a little bit more, and we'll complete our work with assignment number 2. Thanks, everybody. Have a great week 5. If you need anything, let me know, and we'll talk to you next time. Adios.